Welcome back. Today we are going to talk about the nature of fiscal policy and monetary policy in a country like USA and how these policies affect the US macroeconomy. In discussing how these policies affect the US macroeconomy, we will basically focus on several important macroeconomic variables such as the GDP, the interest rate, and inflation, the price level of the economy. Let us start with a formal definition of these two different kinds of policies, mainly the fiscal policy and the monetary policy. I will start with the fiscal policy. Fiscal policy refers to the actions taken by the fiscal wing of the government. There are two main fiscal policy tools that the government regularly uses. They are taxes and direct changes in the government expenditures. Now, although when you think about fiscal policy or when you discuss about fiscal policy, tax policies appear to be at the forefront of the discussion, but government expenditures play equally important role in a country like USA because government expenditures, or just G, is a core component of GDP. Now, when we talk about the tax policies, we know that the government has a wide array of tax policies that are available to their disposal that they can change and have considerable effect on the macroeconomy. Some of the important tax policies that we regularly talk about are tax policies related to personal income tax, which consumers or households pay, corporate income tax, which basically firms pay, and then there are these other taxes which are also important, like the customs tax. For example, export tax or import taxes have been used as fiscal policy tools in many other countries around the world. On the expenditure side of the government expenditures can have a wide variety of avenues through which they have a direct effect on the macroeconomic outcomes. The most important of the government expenditures include these so-called government investment expenditures on all levels of the government: the federal level, the state level, and the local level. Government investment expenditures mainly refer to the kind of expenditures the government carry out as a sort of investment towards the economy, right? So if you think about the federal government building a national highway, that would be an example of government investment expenditures on infrastructures. If the state government constructs a university or a hospital, that could be considered an investment expenditures towards the local economy. And sometimes when you think about the local government, they carry out a lot of these expenditures as well, like expanding the size of the police department, your waste disposal services. These are services provided by the government, and government every now and then updates those services, expands those services, and these are all investment expenditures. Now, in addition to the so-called investment expenditures by the government also has other, critically important expenditures that they carry out, like the defense expenditures, Medicare, Social Security. These are major component of the yearly government expenditures that we see in the budget. In addition to these expenditures that obviously have important effect on the macroeconomy, government carries out a large amount of so-called transfer payments, such as Medicaid, which is free medical insurance or services, and unemployment benefits. A discussion about government expenditures or government in general cannot really be complete if we do not talk about the budgetary process and an important issue called debt, national debt, because national debt is regularly discussed in political discourse. So let us start with defining something called budget balance, which is a difference between tax revenue and outlays. Outlays are the kind of government expenditures that we have been talking about so far. Now there are times when the budget deficit, whenever there are times when the tax revenue basically turns out to be less than the outlays of the expenditures, and your budget balance becomes negative. We generally call that a budgetary deficit. Now, deficit itself, sort of initiates a lot of government fiscal policy. One of the most common response to a budgetary deficit is that government borrows money from the macroeconomy and from the rest of the world to finance their budgetary deficits. The primary vehicle through which the government borrows this money or monetary resources is by selling US Treasury bonds to the general public and at the same time to the rest of the world. Now, the amount of debt that is outstanding that arises from past budgetary deficit is called national debt. Okay. So one can therefore see that the national debt has a very strong relationship with the various fiscal policy activities by the government. If the government collects too little tax revenue, or if the government incurs too much expenditures or outlays, deficit will go up, and if deficits go up, national debt should naturally go up. It should be mentioned that the US government, the federal government budgetary balance has been negative since the early 80s, with the exception of only 2 years during the Clinton administration. So budgetary deficit and the accompanying rise in national debt in USA is not a new phenomena. Let us now move to the other side of the policy spectrum. Now we will talk about monetary policy. Monetary policy is equally important for the US macroeconomy. Monetary policy is undertaken by the monetary wing of the government. For a country like USA, the monetary policy is coordinated and designed by two institutions. One of them is part of the federal government, and the other one is a semi-independent institution. The government institution that is part of the monetary policy is called the Department of Treasury, and the semi-independent government institution. The reason why I am calling this semi-independent will be discussed later on. Although on pen and paper, the Fed is the Federal Reserve Bank is supposed to be completely independent. The Fed, or the Federal Reserve Bank, is going to be the focal point of our discussion today when we talk about monetary policy. The objectives of monetary policy is almost always the same. It is designed to control the money supply in the economy, which can be represented by the quantities of money available in the economy. Now, there are two major ways through which money supply can be increased. One is when more lending is done by private sector banks, so people have more money at their disposal, and money supply increases. When more money is available in the hands of the people by some direct policy initiated by the Fed, can also be a way to increase money supply, and we will now look at various ways this money supply of the economy can change. Before we talk about that, I guess we should spend a little bit of time trying to understand the role of the central bank or the Fed in a country like USA. For USA, the Fed is basically the central bank. The Fed is the institution that is designed to carry out a wide array of activities. Let us summarize some of them. First of all, the Fed oversee the banking system, the private banking system in our country. The Fed regulate the quantity of money that is available in the economy. They do it by controlling the quantity of money available in the economy, and also by designing monetary policy designed by basically their so-called Federal Open Market Operation Committee, which is the sort of administrative body inside Fed that basically will be involved in buying and selling treasury bills. We will explain that later on. The Fed also monitors each bank's financial condition. Every year banks have to submit documents related to the financial viability of their institutions. The Fed will analyze those, and the Fed will also make recommendations as to how private sector banks can improve their banking performance. One of the less known activity of the Fed, which might be probably their most important role in the financial sector, is that Fed facilitates bank transaction. They help individual banks to clear checks. Let me give you an example. Imagine that you have a Bank of America account and you are writing a check to your friend who has a Chase Bank account. So whenever you give your friend that check and your friend deposits that check to the Chase Bank, money really does not transfer from the Bank of America account that you have in your hometown to the Chase Bank account that your friend has in a different state or in a different place. Instead of that, what happens is that the Bank of America has a reserve with the central bank, and so does Chase Bank, which is sort of like a bank account with the Fed, inside the Fed. And whenever that check is issued, Fed will simply take the money in their deposit from the Bank of America account and transfer that to the Chase Bank account. Now you might think that this is not a big deal, but imagine that the amount of time it takes for your money to be taken away from your account and then be deposited to your friend's account might take time, and it does take a lot of time. In other countries, money physically gets transferred from one bank account to another bank account, but in USA, as a result of the intermediation by the Fed, this transfer is almost instantaneous. It is very quick. So by facilitating these transactions, Fed has made our financial system, at least on the banking side, very efficient and very quick. Another very important role of the central bank is that the Fed acts as banks of the bank, right? It's a bank of the bank. What does that mean? It means that just like you and I have accounts with the Fed, with our bank, all banks in USA have accounts with the Fed. The Fed uses those accounts for a variety of reasons to basically stabilize the monetary system in the USA. I have already provided you with one example as to how these accounts could be used to facilitate transaction. There are other reasons why Fed will want individual banks to have accounts with them. When we talk about other monetary policy instruments, we will have another look at it. But the most important reason why Fed has all these accounts with individual banks is that Fed is almost always the lender of the last resort, which means that whenever private sector banks run into severe liquidity and they don't have any other source to get those liquid funds for their day-to-day transaction, Fed always comes forward and helps them. So since the 1930s, after the Great Depression, the role of the Fed acting as the lender of the last resort has been one of the most important role the Fed plays for the stabilization of the financial sector in the USA. Okay. Now let us spend some time looking at the various monetary policy that is undertaken by the Fed. From the onset, we are going to classify these monetary policies in two categories. The first set of monetary policies are the ones that we will call sort of conventional monetary policies, which means that these are policies that the Fed has been undertaken over the last 70-80 years, and they are very common set of policies that central banks in other countries also carry out. The first one is obvious. The Fed, with coordination with the Treasury Department of Treasury, prints money for the US economy. Now, contrary to common belief, this is actually not a common or regular practice. The Fed really does not print money every day or every year. They print money after a while, whenever there are indications that money in the US economy has been destroyed, or some previous money has become old and torn up, and then there are some new money that needs to be printed. The second policy that the Fed undertakes is called changing the required reserve ratio. Required reserve ratio is the fraction of the deposits that each individual bank need to hold as a reserve, either in their own bank account and most preferably with the Fed. So you can see clearly that the required reserve restricts how much borrowing that can be made by an individual bank. Sometimes by lowering the required reserve ratio, the Fed can allow more borrowing by individual private banks, and when the Fed does that, it basically increases the money supply of the economy. The required reserve ratio is also a fairly uncommon monetary policy tool. Part of the reason is because whenever Fed changes the required reserve ratio, it creates a lot of administrative problem and chaos in the financial sector, right? So banks, whenever they get a change in required reserve, have to quickly take part of the money that they have as deposits and have to put that money with the Fed in there as a reserve. It creates a lot of administrative complications, and Feds around the world tries to avoid that. Obviously there are cases when they do undertake these policies. The next one is called the discount rate. The Fed can change the discount rate very frequently. The discount rate is the rate, is basically an interest rate, and this is the rate that the Fed charges whenever private sector banks borrow money from the Fed during liquidity crisis. If the Fed lowers this discount rate, banks will borrow more from the Fed. If they borrow more from the Fed, they will probably lend more to the macroeconomy. When they borrow more and lend more to the macroeconomy, this can lead to an increase in the money supply. Thereby, by lowering discount rate, the Fed can necessarily increase the money supply in the economy. Now this one is a fairly common and popular tool. Why? Because it really doesn't have any administrative or disruptive effect on the overall financial sector. It just involves transaction between the Fed and private sector banks, and those transactions or complications associated with the transaction can be resolved fairly quickly. The Fed in USA has used the discount rate policy several times in the past. Other Federal Reserve banks around the world frequently, and I mean frequently, uses the discount rate. The final conventional monetary policy, and probably the most popular one, is this so-called open market operations by the Fed. Okay, so let's explain that a little bit. So the Fed can control the money supply in the economy by conducting open market operations. Open market operation is the process of selling and buying US Treasury bonds with the help of the Treasury Department, but through the Fed. The Fed has several windows across some of their Federal Reserve banks, where individuals can go and buy to US Treasury bonds directly from the Fed, and Fed sometimes also buy US Treasury bonds directly from the people as well. When the Fed conducts, let's say, an open market sale, they sell US Treasury bills or bonds to the general public. As a result, the Fed collects money from the general public, which means the general public has less money at hand. They have more bonds, which is a piece of paper, an IOU. But by doing that, the Fed effectively can reduce the money supply of the economy. The opposite is true when the Fed undertakes an open market purchase, where they buy bonds from the regular general public, and when they buy treasury bonds, the money supply increases. So these four were or are the main conventional monetary policy tools that the Fed undertakes. Let's now switch our attention to the unconventional monetary policy that the Fed in USA has been subject to in recent times. This is a very interesting discussion about the Fed. Our story basically starts with the 2007-2009 financial crisis, where for the first time the Fed initiated a series of rather unconventional monetary policy, in the sense that they never use this set of monetary policy tools before, because they were not thought to be possible by the Fed. So let's go on and take a look at some of them. Part of the reason why Fed sort of moved towards using these unconventional monetary policies is that during the massive financial meltdown of the 2007-2009, the conventional monetary policy instruments were not sufficient. They were not effective enough, and the Fed needed to act quickly to stabilize the macroeconomy. So in 2008, the Fed and the Treasury Department unveiled a plan to Congress to authorize about $700 billion used to purchase mortgages and mortgage-backed securities. If you remember, during that time, the mortgage market basically collapsed. It completely melted down. The mortgage rates were extremely low. Huge amount of mortgages were defaulted, and to make things worse, it's basically since the 2004-2005 era period, a lot of financial institutions were designing these so-called mortgage-based securities, which are basically instruments that derive their value from the underlying assets, which are basically mortgages. So anytime the mortgages were defaulted, the value of those financial instruments basically became zero, or in some case negative. So with this kind of toxic mortgage-based securities and the mortgage market collapse by itself, the Fed needed to act. One of the things that they did, which is unprecedented in USA, is that they started buying those toxic assets from the financial institutions. And the objective at that time was very simple. The Fed wanted to liquidify these financial institutions because they were suffering from tremendous liquidity crisis. The Fed also used this Troubled Asset Relief Program, TARP, in more popularly known, to make direct preferred stock purchases in banks to increase bank capital. So what happened was that as a result of these series of bad performances, the banks were suffering a massive devaluation of their stocks, and nobody was willing to buy bank stocks because if you remember, Chase Bank and Citibank were on the verge of defaulting, on the verge of filing for bankruptcy. During that time, several major banks filed for bankruptcy because they simply could not sustain the loss. The government was unable to help some of the banks. If you remember Wachovia Bank, they were allowed to die, but then there were some banks which the Fed determined were too big to fail. They were basically saved by the Fed by using the TARP program funds. Okay, so in addition to that, in 2009, the Treasury administered a stress test to 19 large financial firms in order to reassure investors that the firms had sufficient capital to deal with a severe economic downturn. So they started basically creating like a ranking of how these institutions are doing. Part of the reason was very simple. The Fed and the Treasury Department wanted to restore the confidence of the general people on the performance of these financial institutions. The stress test also revealed massive weaknesses in the infrastructure and in the performance, in the organization of several important institutions such as Bear Stearns. And Bear Stearns case is very interesting because government in 2008, before even the TARP, the stress test was initiated, government started saving Bear Stearns from failing, because Bear Stearns, if you remember, is a major financial institution, and the argument in favor of saving Bear Stearns was that a fall of Bear Stearns would send shock waves across the financial institutions and the financial markets. Another major institution during this debate or during this crisis was the American International Group, or AIG. It is a financial institutions that provides insurances, and some of those insurances were connected with the mortgage market and the mortgage-backed securities. When those markets melted and when those markets were destroyed, AIG had to provide insurance for those losses, and they did not have enough capital to sustain those losses for them. So what the Fed did, and this is unprecedented, is that they provided liquidity services to AIG with in exchange for 80% of the ownership of the firm. So this is for the first time the Fed basically owned other financial institutions, and this is and AIG is not the only institution. Because AIG was interconnected with so many other parts of the global financial system, the Fed argues that if AIG fails, it will have a massive effect on the global financial market. Now, AIG had something in their favor going on. They had a lot of assets that could be used as collateral in these transactions that we are talking about. To prevent its collapse, the Fed basically loaned AIG about $85 billion using the AIG assets as collateral. So, it's not like that Fed basically bought part of AIG, but one can argue that this is basically was sort of like a collateral-based ownership of the AIG's assets. The Treasury Department also provided assistance. Now, I would like to mention before I move on is that ever since that financial services were provided to AIG sort of turned around. they have not only repaid all the financial assistance, the $85 billion that they received from the Fed also has transferred all the ownership of that 80% of the shares of AIG to their original stockholders. Okay, so everything has come back to normal. Now, some of these government Fed interventions were controversial, for obvious reasons. People really did not like the idea that Fed was literally buying U.S. companies in some sense, and the argument in favor of such dramatic intervention was also obvious, because without this kind of dramatic interventions, the 2007-2009 financial crisis could not be averted. And regardless of what kind of stand you take against these actions, the effect and the outcome of these policy actions are obvious. Because if the Fed did not undertake this kind of unconventional monetary policy, we would still be in a financial crisis. Our financial crisis of 2007-2009 had the potential that it could linger like the Great Depression, which it did not. Now, the government at that time also initiated some policy framework that might make it unnecessary for the Fed to intervene in the financial sector like the way they did in the 2007-2009 crisis. So the government argued that part of the problem of the financial crisis was that financial institutions were exploiting general customers, general consumers, by keeping them in dark, by selling them basically toxic assets, and that was the main source of the financial collapse. So and also they argued that part of the activities of the Wall Street companies and financial institutions are very much unchecked. So in order to maintain some kind of sort of like a oversight of the financial activities, the government in 2010 passed this Consumer Protection Act. It's basically Reform and Consumer Protection Act. It is popularly known as the Dodd-Frank Act in 2010. The Dodd-Frank Act of 2010 created the Consumer Financial Protection Bureau, CFPB, to deal mainly with deceptive practices by financial firms. As some of you might know, that the Dodd-Frank Act has been basically dismantled like a couple of weeks ago, and the Consumer Financial Protection Bureau has been disbanded. It will probably take a couple of months, but it will go away, despite the fact that the Consumer Financial Protection Bureau has helped billions of dollars to consumers. It has protected billions of dollars of consumer money by basically penalizing financial institutions for fraud practices and other kind of misdoing by the financial sectors. If you remember, in recent times there was a sort of financial malpractice by Wells Fargo Bank, and as a result of the financial malpractice, they were fined a very hefty amount of money, and this was basically done by the Consumer Financial Protection Bureau. Okay, so that's basically the discussion about the unconventional monetary policy by the Fed. Let us now, have a sort of debate about how would you criticize the unconventional monetary policy about the Fed, or to make things a little bit broader, we can have a general criticism about the Fed itself. Okay. Now, there are several critical issues related to the way the Fed operated during the 2007-2009 crisis, and Also, one can argue the same things for how the Fed might operate in the future. Okay. Some of these arguments are as follows. So supporters of CFPB argue that the financial crisis of the 2007-2009 revealed that more regulation for consumer lending and other financial services is necessary, because the banks are too big, they have a lot of legal experts, and most of the people don't have sufficient financial knowledge, so they can be fooled very easily by the large financial institutions. Now the critics argue that the CFPB had imposed unnecessary amount of complexity in carrying out financial transactions. If you have had a chance to apply for a mortgage loan or any kind of credit loan, secured credit loan in recent times, you would know that now you have to go through a series of paperwork which did not exist before 2010. Part of the increased in administrative activities and paperwork basically involves putting more sort of security for protecting the right of the consumers. But the critics argue that this has caused financial transactions to slow down. They argue that the financial complexities have increased the cost of financial transactions, and they argue that the cost of these financial complexities, the cost of these regulations basically outweigh the benefit of these regulation. So that's completely two ways of looking at it. Now one is to understand that there are also other problems, general problems for the Fed. First of all, the Fed isn't completely insulated from external pressure, although in principle, by law they are supposed to be independent institutions. They are supposed to be autonomous institutions that should not be influenced by the government. But that's obviously not true, and we should all understand that. The president can exercise control over the membership and may appoint a new chairman of Fed every 4 years. The chairman of Fed is a political post, and you have to have Congress approval to appoint a new chairman. So it is obviously a political process. The U.S. Constitution does not specifically mandate a central bank. That's something that was unknown even to me. So the Congress basically can abolish the Fed anytime if they have sufficient support. Now, another problem is that elected officials lack formal control of the monetary policy, which has occasionally resulted in conflict between the Fed and the president, right? Because monetary policy does have direct macroeconomic effects, and macroeconomic effects have political consequences, and political consequences affect the administration, the policymakers. So there is a confusion and there is a tension between the policymakers and the the macroeconomic policymakers, which are basically political leaders, and the policymakers in the Fed, who are supposed to be independent, and that tension hasn't really ceased, but I would argue it has increased over the time. Okay, so there are also so that basically takes us to this debate as to what we think the role of the Fed should be. Should the Fed be an independent organization, or should the Fed be integrated with the federal government? So the debate basically is, should the Fed be independent or should it not be independent? There are strong arguments on both sides. Let's start with the argument in favor of Fed's independence. The main argument for Fed independence is that monetary policy is too important and technical to be determined by politicians who basically do not have the academic or theoretical background, or in some case empirical background, to understand these policies altogether. Because the frequency of elections, politicians may be short-sighted, concerned about the short-run benefits without regard to potential long-term cost and consequences of their monetary policy. So it is better that they do not interfere with the monetary policy. Now, one could argue that the public might basically prefer the experts at the Fed, who are basically economists, finance, and real life empirical policymakers, rather than politicians, to make monetary policy decisions. Another argument for Fed independence is that complete control of the Fed by elected officials increases the influence of political parties. And that can lead to something called political business cycles, where the policy environment changes dramatically with the change in political parties, which we do see happening in the overall macroeconomy, but probably similar kind of policy changes in accordance with changes in the political parties in the monetary policy arena probably is unwarranted. So, these are probably main arguments in favor of Fed independence. Now, there are also equally compelling arguments in favor of making the Fed part of the federal government, right? The first one is again obvious. Since the Fed is such an important policy institution that makes very critical monetary policy decisions, they have to be part of the government. Otherwise, how would the government design those policies? One could argue that in democracy, elected officials should make public policy. Why? Because if they make a mistake, the public can hold them accountable for their mistakes, and they can change those political party leaders. If the central bank was controlled by elected officials, monetary policy could be coordinated and integrated with government taxing and spending policies. This is a very contentious argument, and there are strong supporters and also critics of this idea. A lot of people argue that there should be independence between the fiscal policy and the monetary policy of the government. Some would argue that it already exists. It doesn't exist, even when there are restrictions that say that monetary policy and fiscal policy cannot be coordinated, or should not be coordinated, or are not coordinated. In reality, they are. You might and you can think of a variety of different scenarios when the Fed has to respond with monetary policies to changes in fiscal environment. Now, there are also other criticisms of the Fed. So some of the criticisms basically stem from their slow response to macroeconomic conditions. Some critics noted that Fed failed to assist the banking system during the economic contraction of the early 30s, but that's a long time ago. The assertion is true, by the way. During the Great Depression, the financial system did not get that much help from the Fed, because the Fed at that time did not really know what to do. But over time, that has changed a lot. The Fed has established institutions like the Federal Deposit Insurance, FDIC, which has dramatically stabilized the financial system. Also, in recent times, critics argue that the Fed ignored the housing market bubble in the early 2000s and then moved too slowly to contain the effect of the bubble burst in 2006. Part of that obviously is true, but again, who would have thought that the mortgage market bust, which has happened before, would have such a large scale consequences on the financial sector of the economy. So, with that, let us now move forward and have a more operational understanding about how the monetary policy wing of the government affects the overall macroeconomic outcomes. The effect of monetary policy over the macroeconomy basically comes from how Fed controls the main interest rates in the economy and how those interest rates affect the overall macroeconomic outcome. interest rate is the heart, or is at the heart of the macroeconomic debate. Everything in the macroeconomy is affected by changes in the interest rate. How many houses you buy, how much money firms can borrow from the banks to invest, whether you are going to buy stocks from the stock market or just put the money under your bed. These are all influenced by interest rates across the various markets in the economy. Now, the Fed plays a critical role in streamlining and affecting almost all of these interest rates. In order to have a better understanding about how the Fed can control the interest rate of the economy, we are going to develop a very simple model of money demand and money supply to basically understand that. In figure 1, what you're looking at is a very standard money demand money supply model where basically we have a demand curve that shows the demand for money, and we have a supply curve that shows the supply of money. The two-dimensional space where we are drawing these curves are interest rates and quantity of money. So basically we are saying that the interest rate is the price of money demand and money supply. Now, the money demand basically refers to how much money you would like to hold in your hand. You might want to hold that money for a variety of reasons, right? To carry out your day-to-day transactions. If there is a certain increase in the overall price level, you might actually need more money. Sometimes if you have more income, you might want to hold money just to show off to other people, right? Now, when any of these factors changes, when the amount of transactions that you make changes, your income changes, you might want to hold more money, and the money demand curve will shift up. Now, you should notice that the money demand curve is downward sloping, which means that if the interest rate goes up, money demand goes down, and vice versa. So let's try to explain that. Whenever there is an increase in interest rate, for an individual, it makes less sense to hold money, because by holding money you don't earn anything, right? Rather than, in addition to that, when the interest rate is high and if you hold money at hand, you lose the possibility that you could have earned this interest rate by putting your money in a fixed deposit or by buying interest bearing assets such as stocks and bonds. So therefore, anytime the price level, the interest rate of the economy goes up, money demand goes down, and vice versa. Okay, the money supply is a very simple process. We believe that the money supply of the economy is entirely controlled by the Fed, and anytime, so it doesn't really depend on the level of interest rate that is available in the economy. So therefore, we can argue that the money supply curve is vertical. Okay, so now let us spend a little bit of time trying to understand how the money demand curve and money supply curve affects the interest rate. Let's start with a situation where the money demand curve, there is an increase in money demand, right? So if there is an increase in money demand, this could be as a result of an increase in your income or some other factor. Your money demand curve is going to shift to the right, and if it does, notice that your interest rate, which was basically found at the intersection between the old money demand and the old money supply, that's called the equilibrium interest rate. But when money demand curve shifts up to MD1, you can see that the interest rates basically go up to R3. So an increase in money demand increases interest rate. The next one to consider is to think about an increase in money supply, let's say from money supply to MS1, and you can see that with unchanged money demand curve, the equilibrium interest rate basically goes down to R4. So an increase in money demand, interest rate goes up, an increase in money supply, interest rate goes down. So therefore, you can see clearly that monetary policy, by changing the money supply, can actually have a direct effect on the interest rate of the economy. Now, how the interest rate affects the macroeconomy is going to be the next topic that we are going to cover. Okay, so in order to understand the effect of monetary policy in affecting interest rate and how that interest rate affects our macroeconomic outcomes such as GDP, inflation, and cause a variety of macroeconomic events such as recession, we need to really develop a macroeconomic model, right? And the macroeconomic model that we are going to develop is going to be called an aggregate demand, aggregate supply model. And I would like to provide you with a brief sketch of the model because the actual discussion is much more rigorous in your traditional macroeconomics course. So let's look at that. We will try to develop a aggregate demand, aggregate supply framework where it will look very similar to our traditional market demand supply model, but this will be a demand supply model where the demand is going to be for the entire macroeconomy, the supply is going to be for the entire macroeconomy, and the price will be the overall or general price of the economy, right? So there will be some changes. Let's start with the aggregate demand side. Now the aggregate demand basically talks about the real GDP of the economy, and there are various ways to calculate real GDP. One popular method called the expenditure method calculates GDP as follows. It takes C, I, G, export and import and get the GDP as follows. Your GDP is the sum of C, I, G, EX and a subtraction of import from that, and you get GDP, where C is the personal or household consumption. This is the money that you and I spend. I is the gross private investment. This is expenditures made by firms. G is the government expenditure at all level of government, something that we have talked about before. EX is export and IM is import. Okay, so we are now going to show how we can derive an aggregate demand curve where the GDP or the aggregate demand of the economy is a function of price, in this case a negative function. Our aggregate demand curve is going to be a downward sloping demand curve, which means that it will show that anytime the price level of the economy goes down, the aggregate demand will go up, and vice versa. So if you think about aggregate demand in this two-dimensional space where Q is now output, P is the price, anytime price goes down from P1 to P2, aggregate demand increases from Y1 to Y2. So the question is why, right? Why does aggregate demand increase whenever there is a reduction in price? Economists argue that there are basically three different effects that coming together cause your aggregate demand to go up when price goes down, and vice versa. The reason why we need to look at each of them is because when price changes, your aggregate demand will change only when some or all components of aggregate demand change. So let's look at some of them. The first one is called the wealth effect. Wealth effect is almost completely associated with consumption. So let's look at that. So when the price level goes up, the real income of the consumers go down, which means that their purchasing power goes down. What does that mean? It means that when prices go up, with your income you can now buy less, right? So your real purchasing power goes down, so you buy less. Therefore, when price goes up, your consumption basically go down. It's a very simple argument, right? But the consumption goes down because your wealth goes down. The next one is probably the most important reason why an increase in price causes aggregate demand to go down, and vice versa. Imagine the price of the overall market or economy going up. By the way, the price of the overall economy is usually measured by consumer price index. Sometimes we also use something called GDP deflator. When the price goes up, as we have learned in our money demand, money supply model, that it is going to increase our demand for money. So the money demand curve will shift to the right. And if the money demand curve shifts to the right, it will raise the interest rate of the economy. Okay, so when the interest rate rises, it is obviously becomes harder for firms to borrow from banks, right? Or from other financial institutions like stock market. Why? Because they have to pay a higher interest rate, which means that the cost of borrowing is higher. Almost always, a rise in interest rate causes firms to borrow less. When firms borrow less money from financial institutions, they also invest less in the macroeconomy, in their own firms. So as a result, a rise in interest rate as a result of a rise in price level of the economy causes investment to go down. The last one is kind of interesting, the exchange rate effect. As it turns out that an increase in the overall price level of the economy can have a similar devastating effect on the trade of the economy with other countries. To begin with, if the price level of the economy goes up, your domestic goods are more expensive than foreign goods. This will have two effects. First of all, foreign buyers would be less willing to buy your good, and your domestic consumers will be more willing to buy foreign goods. Okay, you can see immediately that whenever price goes up, exports are going to go down, imports are going to go up. Let's analyze that a little bit more. Let's analyze that in the context of an exchange rate. When price of the macroeconomy goes up, it means that foreigners are going to buy less of our good, which means that they will buy less dollar because they don't really want to buy any more US goods for which they have to pay the dollar, right? So when the price of the domestic economy goes up, the demand for dollar goes down. People are willing to buy less dollar. At the same time, when the domestic price goes up, domestic consumers want to buy more of foreign goods, which means that their demand for foreign currency goes up because they need that money to buy foreign goods. So you're seeing two things, right? When the price goes up, demand for US currency, dollar, goes down, and the demand for foreign currency such as euro or yen goes up. This causes our exchange rate to what we call appreciate. The value of the money goes down. And if that happens, if this appreciation occurs, that basically causes your exports to go down and your import to go up. When you combine these three effects, the wealth effect, the interest rate effect, and the exchange rate effect, and go back to the definition of the GDP or aggregate demand, you can see clearly that on the right hand side, an increase in price causes consumption to go down, investment to go down, export to go down, and import to go up, which means that whenever price goes up, aggregate demand goes down. That basically is a summary of why the aggregate demand curve is downward sloping in this two-dimensional space, where price and real GDP are on vertical and horizontal axes. Okay. Before we move on, we need to remember that there are several factors that could shift our aggregate demand curve, and this discussion is very important. The first one is something that we already have discussed. Whenever there is an increase in money supply, which you can see on the left side of figure 3, an increase in money supply causes interest rate to go down, and when interest rate goes down, it decreases the cost of borrowing by firms. The cost of borrowing by firms go down when interest rate goes down. When interest rate goes down, firms borrow more. If they borrow more, investment goes up, and if investment goes up, aggregate demand shifts to the right. There are other channels through which aggregate demand can change. The example that we have just provided is an example of how monetary policy shifts the aggregate demand. But there are other policies that can also shift the aggregate demand, namely fiscal policy. To begin with, we can think about the first one, which is an increase in government purchase. Now, G is a direct component of aggregate demand or GDP. So whenever G goes up, your aggregate demand shifts to the right. The effect of taxes are much more complicated in affecting aggregate demand. Whenever you increase in a personal tax, it means that people have to pay more tax on their income, so their disposable income, which is after tax income, goes down when personal income taxes are raised, which means that they can now spend more money, which means that their consumption is going to go down. So an increase in personal income tax will surely reduce your consumption expenditure. An increase in business taxes, like the corporate profit tax, will cause firms to invest less. As a result, investment will go down. In either way, a rise in taxes should have the indirect effect that it will reduce either consumption or investment or both, and will cause the aggregate demand to shift to the left. So to summarize, an increase in government expenditure shifts the aggregate demand to the right, and the increase in taxes and on either consumer or on producer causes aggregate demand to shift to the left. Okay, there are some other factors that can also shift the aggregate demand, and I think due to some recent policy changes, this is an interesting discussion to have. Let's imagine that your country is growing more than other countries. Okay. So if there is a increase in growth of GDP related to the growth of the other countries, one could argue that this might probably lead to an increase in import. Now, it is counterintuitive. Let me explain it to you. When GDP grows, people's income grow. When people's income grow, they feel like they want to buy better quality product like caviar or a BMW car. So they want to buy all these foreign-made luxury goods, and import could go up. When other countries are going less than USA, they probably don't want to import goods from USA. So US exports go down. In either case, your aggregate demand is going to shift to the left. The one that is currently getting the most review is how the effect of exchange rate affects aggregate demand. So if there is an increase in exchange rate, the value of US dollar relative to foreign currencies go up. If the dollar becomes stronger, that's the argument. If the dollar becomes stronger or appreciates, it means that for foreigners it is more expensive to buy from USA. So as a result, it will exports to foreign countries will go down. And if dollar is stronger, it means that it makes it easier for domestic consumers in USA to buy from foreign countries. It becomes easier for them to do that. So whenever exchange rate appreciates, we expect exports to go down and imports to go up, which means that aggregate demand will again shift to the left. The effect of these shifts of aggregate demand on the macroeconomic outcomes will be discussed in a minute. So that's basically discussion about the aggregate demand, the aggregate demand side of our aggregate supply framework. Let us now spend some time talking about the supply side. The supply side discussion is pretty interesting. We are going to talk about the supply side in two different dimensions. First of all, we are going to talk about the short-run supply curve, because the supply curve in the aggregate demand aggregate framework has two different curves. The first one is called short-run aggregate supply curve. That basically shows how the producers of the economy responds to changes in the price level in the short run. Without going into the mechanics of this sort of formulation, we can argue that in the short run, if the price increases, it increases the profitability of the firm, so therefore they would be inclined to produce and supply more in the market. So the long-run short-run aggregate supply curve, the short-run aggregate supply curve is upward sloping, just like your traditional supply curve in the market model. But in our macroeconomic model, there is another curve called the long run aggregate supply curve, and this is a little bit different one. Okay. Now, the long run aggregate supply curve is basically is based on the idea that in the long run, the real GDP of the economy determines the shape of the long run aggregate supply curve. And there is a common perception among macroeconomists that in the long run, prices really cannot affect how much output an economy produces. The economists argue that in the long run, how much GDP the economy can produce depends on the productive elements of the economy. How much labor it has, how much capital it has, how much human capital it has, how much natural resources it has. So based on that idea, economists argue that in the long run, the total GDP of the economy is basically independent of the price level. What that means is that in the long run, we assume that the supply curve is basically vertical, and that's what you see in the curve, that these are all vertical, aggregate supply curves. Now, does that mean that there cannot be any change in the long run aggregate supply curve? The answer is no. Anytime there is a increase in natural resources, or the economy somehow finds more labor, or imports more labor, or buy more capital, your long run aggregate supply curve might shift to the right. Anytime there is a natural disaster and natural resources are destroyed, your long run aggregate supply curve will shift to the left. So that's two different kinds of supply curve with an aggregate demand. That basically takes us to long run macroeconomic equilibrium, which is obviously found at the intersection between the short run aggregate supply curve, long run aggregate supply curve, and our aggregate demand. The intersection between these three curves basically tells us the market equilibrium price, which is determined on the vertical axis, and it tells us the market equilibrium output, which is the GDP of the economy. That basically concludes our discussion about the macroeconomic models that we were interested in. Now, we want to use that macroeconomic framework to talk about how monetary policy and fiscal policy basically can create a whole host of macroeconomic outcomes such as inflation and recession. So what I will do is I will draw those, and I will they are pretty standard. So let's look at that. So imagine, so we are now first going to look at the effect of fiscal policy in creating inflation. Okay, so imagine that we have a macroeconomic model equilibrium where the long run aggregate supply curve and the short run aggregate supply curve and our aggregate demand all intersect with each other at point, at the intersection. Let's say the original macroeconomic price is P, original macroeconomic output is Y star. Now let's think about case one. For a variety of reasons, let's imagine that the aggregate demand of the economy has gone up from AD to AD1. Okay, that can come from a wide variety of reasons. You can have increase in government expenditures, you can cut taxes on consumers, you can cut taxes on businesses, the government can undertake a massive expenditure approach like the one the government did during the 2007-2009 crisis. And if aggregate demand increases, notice that price goes up from P star to P1 at the new equilibrium, and the economic output also increases. So that is an example of how fiscal policy basically can create inflation in the economy. Okay, let's now move on to, I want to write it down so that we remember. So if there is an increase in G, that's a fiscal policy, or a cut in tax, that's also a fiscal policy. Aggregate demand increases, and if aggregate demand increases, there is inflation. Okay. Let's now look at the monetary policy side. The monetary policy side can come from the fact that we think about how, start with the money supply, money demand model, and let's imagine that, and let's say corresponding to that market equilibrium, there is a long run equilibrium again at P star and Y star with aggregate demand, short run aggregate supply, and long run aggregate supply. So we need two graphs to understand that. Suppose money supply increases from MS to MS1. So remember, this has interest rate and this has price. In the upper panel, we see that whenever money supply increases, it causes equilibrium interest rate to go down from I star to I1. So if interest rate goes down from I star to I1, we know that investment component of aggregate demand increases, which means that aggregate demand shifts up from AD to AD1, and which also increases the price from P star to P1. So we can argue therefore that if money supply increases, it causes interest rate to go down, and if interest rate goes down, price increases, which means that there is inflation. So therefore we can see that there are two ways inflation can happen, right? From the fiscal side, if there is a expansionary fiscal policy, such as an increase in government expenditure or a cut in tax, prices go up and inflation happens. If there is an expansionary monetary policy on the monetary side, meaning that there is an increase in money supply, that will cause interest rate to go down, and if interest rate goes down, your price level goes up, which means that inflation is caused. That concludes our discussion today, and if you have any question, please get in touch with me. Thank you very much.